Why investing smartly in 2025 is critical for older adults. In 2025, making smart investment choices is more important than ever for older adults. With market volatility, rising inflation, and historically low interest rates, the financial landscape can feel more uncertain than in years past. These challenges mean it's crucial to think carefully about where you put your money, ensuring it's both protected and positioned for growth. In this video, we'll explore how to strike that balance by focusing on safe investments that generate reliable income while still allowing for modest growth. Whether you're approaching retirement or already enjoying it, we'll show you how to adjust your portfolio to match today's economic conditions, helping you protect your savings and create financial stability. We'll cover a range of investment options, from low-risk bonds that offer security and steady returns to dividend stocks and real estate, which provide both income and growth potential. By the end, you'll have a clear understanding of how to build a portfolio that supports your financial goals in this challenging environment. Let's start by looking at why low-risk bonds remain a cornerstone of a secure investment strategy for older adults. Safe investments. Why low-risk bonds still make sense. Low-risk bonds are a cornerstone for older adults looking to secure their investment strategy in 2025. Bonds offer a reliable way to protect savings while generating steady income, which becomes especially important as people approach or enter retirement. While they may not deliver high returns, bonds provide peace of mind through stability, making them essential for those who prioritize safety over rapid growth. There are different types of bonds to consider, each with unique characteristics. Government bonds, such as U.S. Treasury bonds, are considered the safest because they are backed by the government itself. These bonds offer lower interest rates, but the near-zero risk of default makes them a strong choice for conservative investors. Corporate bonds, on the other hand, are issued by companies to raise capital. Though riskier than government bonds, they typically provide higher yields, rewarding investors with better returns in exchange for slightly more risk. Finally, municipal bonds are issued by local governments to fund public projects like schools or infrastructure. These bonds often come with tax advantages, making them attractive for investors in higher tax brackets. Bonds provide consistent interest payments, which helps retirees generate a predictable income stream without dipping into their principal. This level of security is crucial for older adults who are less willing to take on the volatility of riskier assets like stocks. However, bonds do have limited growth potential. Over time, they generally offer lower returns compared to stocks, which is why it's important to balance them with other investments for long-term growth. In 2025, bonds remain a key component of a balanced portfolio. They cushion against market downturns while offering a stable income, making them especially valuable for retirees. This secure foundation sets the stage for the next part of a well-rounded strategy: dividend stocks, which combine income generation with potential for higher returns. Income with growth. How dividend stocks can offer the best of both worlds. While bonds offer stability and steady income, dividend stocks bring a valuable balance of income generation and growth potential to an older adult's portfolio. Dividends are regular payments that companies make to shareholders, usually drawn from profits. These payments can provide a reliable income stream, similar to bonds, but with the added benefit of potential capital appreciation as the value of the stock rises over time. Dividend stocks are particularly appealing because they combine the security of regular income with the opportunity for long-term growth. Sectors like utilities, healthcare, and consumer goods are known for paying consistent dividends, even during economic downturns. Companies in these sectors tend to be more established and financially stable, which helps them maintain reliable dividend payouts. For retirees, this means a steady cash flow without having to sell off assets, preserving their investments for future growth. However, dividend stocks do come with risks. Market volatility can affect the value of the stock, and in tough times, companies may reduce or even eliminate their dividends. This is why it's important to choose dividend stocks wisely, focusing on companies with a solid history of payouts and strong financial health. Even with these risks, the right dividend stocks can offer a balance between generating income and growing wealth over time, making them a smart addition to a portfolio that also includes more conservative assets like bonds. In 2025, as older adults look to diversify their investments, dividend stocks offer a way to increase potential returns while maintaining a degree of financial stability. They complement bonds by adding growth potential, ensuring that a portfolio isn't overly dependent on low-risk, low-reward options. Together, these two investment types help create a more well-rounded strategy for retirees seeking both security and growth. Real estate as a safe and profitable investment for older adults. Real estate remains a solid and safe investment option for older adults in 2025, offering both stability and growth potential. Just as dividend stocks balance income and growth, real estate adds another layer of diversification to a well-rounded portfolio. With its potential for steady rental income and appreciation in property value, real estate can be an excellent way to generate returns while protecting against inflation. There are several ways to invest in real estate, depending on personal preferences and risk tolerance. Direct property ownership is the most traditional route, where investors purchase rental properties and earn income from tenants. This option can provide consistent cash flow, along with the opportunity for the property to appreciate over time. Another popular option is investing in REITs, or real estate investment trusts. REITs allow individuals to invest in real estate without owning physical property, offering a more hands-off approach while still benefiting from rental income and property appreciation. Lastly, real estate crowdfunding has become an emerging option, enabling investors to pool their money with others to fund larger real estate projects, typically with lower initial investment requirements. Real estate offers several advantages for older adults. Rental properties generate income that can help cover living expenses in retirement, and many real estate investments come with tax benefits, such as deductions for mortgage interest or property depreciation. Additionally, real estate tends to appreciate in value over the long term, offering the potential for capital growth. However, there are risks to consider. Property values can fluctuate during market downturns, and owning rental properties involves the challenges of property management, maintenance, and dealing with tenants. REITs and crowdfunding options reduce some of these headaches, but come with their own risks, such as market volatility or project delays. For older adults, real estate offers a way to diversify beyond stocks and bonds, providing both income and growth potential. As part of a balanced investment strategy, real estate adds another layer of security and opportunity for long-term returns. Balancing safety and growth in an uncertain economy. Balancing safe investments with growth-oriented options is crucial for older adults in the uncertain 2025 economy. While real estate, bonds, and dividend stocks each offer security and income, it's important to include some growth potential to ensure long-term financial health. Relying solely on safe investments can limit returns, especially in times of inflation, while taking on too much risk can jeopardize hard-earned savings. The key lies in finding the right mix that aligns with individual risk tolerance and financial goals. Risk tolerance refers to how much uncertainty an investor is comfortable with. For older adults nearing or in retirement, it often makes sense to prioritize safety, but that doesn't mean avoiding growth entirely. A diversified portfolio, one that combines safer options like bonds and real estate with growth-oriented investments like dividend stocks, can help protect assets while still offering opportunities for modest growth. This approach reduces reliance on any one asset class, helping to cushion against market volatility. In an economy that could experience ups and downs, adjusting investments based on market conditions and personal financial needs is essential. For example, those with a longer retirement horizon may be able to allocate a portion of their portfolio to slightly riskier assets, seeking higher returns to outpace inflation. Meanwhile, those with more immediate financial needs might lean more heavily on stable, income-generating investments, ensuring their essentials are covered without dipping into savings. Ultimately, achieving the right balance between safety and growth allows older adults to preserve their wealth while still keeping their investments working for them. By diversifying across different asset types, they can confidently navigate an uncertain economy with a strategy that supports both their immediate and future needs. Alternative investments for older adults. An overview of precious metals and annuities. In 2025, alternative investments like precious metals and annuities can play a valuable role in diversifying a retirement portfolio. Gold and silver have long been considered hedges against inflation and economic instability. When markets fluctuate or inflation rises, the value of these metals often holds steady or even increases, providing a safety net for investors looking to preserve their wealth. For older adults concerned about protecting their assets, adding a small percentage of gold or silver can enhance security while balancing other investments. Annuities offer a different kind of protection by guaranteeing a steady income stream in retirement. With an annuity, you invest a lump sum with an insurance company in exchange for regular payments, which can be tailored to last for a certain number of years or even for life. This can provide peace of mind, especially for retirees who want to ensure they won't outlive their savings. The predictability of annuities makes them a strong choice for those seeking financial stability in uncertain economic times. However, both precious metals and annuities come with downsides. While gold and silver provide safety during turbulent times, they don't generate income, and their long-term growth potential can be limited. Annuities, on the other hand, can have high fees and often lack flexibility. Once the contract is locked in, it can be difficult to access the money or change the terms. Incorporating these alternative investments into a broader strategy can add another layer of stability to a portfolio. By balancing more traditional growth options like dividend stocks and real estate with the security of precious metals and annuities, older adults can create a well-rounded plan that addresses both immediate income needs and long-term financial security. The role of cash. How much should you keep liquid in 2025? Cash and cash equivalents play a critical role in an older adult's investment strategy for 2025, offering essential financial flexibility. Liquid assets, such as money market funds and certificates of deposit, CDs, provide quick access to cash without the need to sell other investments at a potentially bad time. This liquidity is especially important for covering emergencies or unexpected expenses, allowing retirees to handle life surprises without disrupting their long-term strategy. Additionally, having cash on hand allows older adults to take advantage of new investment opportunities as they arise. Whether it's a dip in the stock market or a promising real estate deal, access to liquid assets provides the agility to act quickly. However, there are risks to holding too much cash. While it's safe from market fluctuations, cash doesn't grow the way other investments can. In a low-interest environment, the value of cash can even be eroded by inflation, meaning that money sitting in a bank or a low-yield account might lose purchasing power over time. That's why it's important to balance liquidity with growth. By maintaining a reasonable amount of liquid assets while keeping the bulk of a portfolio in investments that generate income or grow in value, retirees can stay flexible without sacrificing long-term potential. This sets the stage for making strategic adjustments to investments as retirement progresses, ensuring financial security throughout the later years. Adjusting investments for retirement needs. Shifting focus as you age. As older adults move further into retirement, adjusting their investments becomes essential for managing risk and securing a steady income. Shifting away from riskier, growth-oriented investments towards safer income-generating assets helps protect the nest egg they've built. At this stage, the priority often shifts from growing wealth to preserving it and ensuring enough income to cover living expenses. One effective strategy is the bucket approach, where retirees divide their investments into different categories or buckets based on when they'll need the money. The first bucket holds liquid assets, like cash or money market funds, to cover immediate expenses. The second bucket contains medium-term, lower-risk investments, such as bonds or dividend-paying stocks, providing income for the next few years. Finally, the third bucket can still hold growth-oriented investments, but with a longer time horizon in mind. This approach allows retirees to draw income from safer assets while giving riskier ones time to recover or grow. Systematic withdrawals are another way to manage risk. With this method, retirees take out a set percentage of their portfolio each year, balancing income needs with preserving enough capital for the future. Adjusting investments as retirement progresses helps reduce exposure to market volatility while ensuring a stable income stream. Having the right mix of liquid assets and income-generating investments prepares retirees for both immediate needs and long-term financial security. This naturally leads to exploring tax-advantaged strategies to further optimize retirement savings and income. Tax-advantaged accounts: how to maximize your returns. Using tax-advantaged accounts is a smart way for older adults to maximize returns and minimize tax liabilities in 2025. Traditional IRAs and 401ks allow individuals to grow their retirement savings tax-deferred, meaning they don't pay taxes on contributions or gains until they withdraw the funds. However, once they start taking money out, especially after required minimum distributions, RMDs, kick in at age 73, those withdrawals are taxed as regular income. One strategy to reduce tax burdens is to perform Roth conversions, which involve transferring money from a traditional IRA or 401k into a Roth IRA. While taxes are paid at the time of conversion, the money in a Roth IRA grows tax-free, and future withdrawals are also tax-free, providing significant savings in the long run. Timing is key here. Doing conversions in lower income years can help minimize the tax hit. Health savings accounts, HSAs, are another useful tool. Contributions to HSAs are tax-deductible, and withdrawals for qualified medical expenses are tax-free, making them an excellent way to cover healthcare costs in retirement. Managing withdrawals carefully, especially with RMDs, helps avoid higher tax brackets or penalties. Spacing out withdrawals or delaying them when possible can lessen the tax impact, keeping more money in retirees' pockets. By using these strategies, retirees can maximize their savings while reducing their tax burden. This naturally leads to considering professional financial advice to ensure that these moves align with their broader retirement strategy. The value of professional advice. Should you consider a financial advisor? In 2025, older adults may find that consulting a financial advisor offers valuable guidance, especially when managing complex portfolios or navigating retirement planning and tax strategies. As retirement approaches, the financial landscape can become more complicated, with decisions about asset allocation, required minimum distributions, Roth conversions, and healthcare costs all playing a crucial role in long-term security. A financial advisor can help create a personalized plan that balances income needs with growth, ensuring retirees make the most of their investments while minimizing tax liabilities. Advisors are also equipped to help older adults adjust their portfolios as market conditions change, ensuring they stay on track for a comfortable retirement. When choosing a financial advisor, it's important to look for someone with fiduciary responsibility, meaning they are legally required to act in their clients' best interests. Advisors with experience working with older clients are also valuable, as they understand the unique challenges and concerns that come with retirement planning. In addition to credentials, it's helpful to find someone who communicates clearly and takes the time to understand each client's financial goals and risk tolerance. Building a strong relationship with a trusted advisor can provide peace of mind, knowing that someone is there to help navigate the complexities of retirement. Consulting a financial advisor can be a key step in securing a stable, well-planned retirement, bringing together all the elements discussed, from investments to taxes, into a cohesive strategy. This naturally leads to final thoughts on achieving financial security in retirement. Securing your financial future in 2025 and beyond. To wrap things up, we've covered some of the best investment opportunities for older adults in 2025. Balancing safe investments like bonds, real estate, and cash equivalents with growth-oriented options like dividend stocks is key to building a secure financial future. Diversification helps protect your wealth while still allowing for potential growth, making it an essential part of any retirement strategy. We also touched on the value of alternative investments like precious metals and annuities, as well as the importance of tax-advantaged accounts to minimize liabilities and maximize returns. By adjusting your portfolio as you move further into retirement, you can ensure your investments continue to meet your evolving needs. Remember, it's crucial to regularly review your financial plan and make adjustments as market conditions and personal goals shift. Whether you're focused on generating stable income, preserving capital, or finding opportunities for modest growth, staying proactive will help you maintain financial security in the years ahead. With thoughtful planning and smart investment choices, you can take confident steps toward a comfortable, worry-free retirement in 2025 and beyond.